In this episode, I will explain why mutual funds have gained immense popularity and why people often prefer them over the stock market or fixed deposits. To put it simply, mutual funds offer 4 significant advantages: diversified investment, high liquidity, the expertise of a skilled fund manager, and a low initial investment requirement. Diversified investment means that you're not placing all your assets in one place. Instead, your investments are spread across various assets and sectors. For instance, if you have ₹1,000 invested with your mutual fund manager, they might allocate ₹500 to one stock, ₹500 to a different debt security, ₹1,000 to a promising mid-cap company, and ₹1,000 to one of Mr. Ambani's companies. Furthermore, they may diversify your remaining funds into various other sectors and types of bonds and debts. This strategy offers 2 significant advantages. First, it significantly reduces your risk. If one of the companies in your portfolio incurs losses, the profits from other successful companies can offset it, resulting in an overall gain. This diversification minimizes losses and maximizes gains, a benefit not typically achievable with individual stock market investments. Second, compared to fixed deposits where all your money is with one bank, in mutual funds, your money is spread across different companies and sectors. Therefore, even if one company in the mutual fund portfolio faces financial difficulties, it's highly unlikely that all the companies in the mutual fund will face such issues simultaneously. This is why mutual funds are often considered less risky due to their diversified nature. The second advantage is that in a mutual fund, multiple investors pool their money together, enabling the fund manager to purchase costly bonds that an individual investor might not afford. For instance, if you have only ₹10,000 but wish to invest in a ₹50,000 bond, you may not be able to do so individually. However, by investing your ₹10,000 in a reputable mutual fund, the fund manager can combine funds from other investors like you to acquire that ₹50,000 bond. Consequently, you can anticipate better returns in the future. In essence, mutual funds make the seemingly impossible possible, offering you returns beyond your individual capacity. High liquidity doesn't mean your money will transform into water. In economics, something is highly liquid when it can be easily bought or sold. Mutual funds are also highly liquid financial instruments, easily bought or sold. The advantage of high liquidity is that we can withdraw our money from mutual funds when needed and use it as required. For example, if you've invested in stocks and suddenly need funds, selling stocks at that moment can be risky as stock prices may be down, resulting in losses. Similarly, if your money is in a fixed deposit, withdrawing it abruptly can be difficult, and you may even have to pay fines for early withdrawal. In contrast, being invested in a mutual fund allows you to easily withdraw your money as needed, and you'll receive the amount based on the mutual fund's net asset value (NAV) at that time. This flexibility makes mutual funds a convenient and efficient investment option, providing liquidity when required. The third significant advantage is that your investment is managed by an expert money manager. Making money in the stock market isn't easy and can take many years to gain the required understanding. Despite this, many people find it challenging to fully comprehend the stock market. If you invest in the stock market by yourself, there's a higher chance you may end up losing your money. However, when you invest in mutual funds, your money is managed by a finance expert with excellent knowledge of the stock market who stays continuously informed about it. They allocate your money to well-performing and diversified stocks to maximize returns and minimize potential losses. Your fund manager takes care of all the research, decides which stocks to invest in, and continually monitors them. The fourth significant advantage is that you don't need a large sum of money to invest in mutual funds. With the help of a systematic investment plan, SIP, you can start with as little as Rs 100 per month and invest in mutual funds. This means even an ordinary student can invest in mutual funds. Thanks to the power of compounding, an ordinary person who invests just 500 rupees per month in mutual funds for 15 years can expect a return of around 40,000 rupees, which is nearly 80 times their initial investment. In contrast, when it comes to stocks, this can be quite challenging because many stocks come with a hefty price tag, making them affordable only to those with substantial capital. Besides these prominent advantages, there are several other benefits to investing in mutual funds that further enhance their appeal to investors. One significant advantage is the ease of monitoring your investments in mutual funds. Various apps and platforms allow you to keep a close eye on the performance of your mutual funds and assess various parameters. Mutual funds operate with a high degree of transparency, and you can readily access all the information about the available funds in the market online. This information includes their historical performance and the track record of their fund managers. As an investor, it's essential to leverage this wealth of information and conduct thorough research on mutual funds before making any investment decisions. It's crucial to review their past performance and scrutinize the details to select the mutual funds that align with your financial objectives.